Good evening, everybody. So we'll break it in two parts. For the first, 10 odd minutes, I'll run you through who we are at Buoyant and how our strategy is different. The next 10 minutes, we can essentially run through our views on the market and how we see things going forward. Right. So I'll start sharing my screen. Right. So see, we started Buoyant Capital in June 2016. It was founded by three of us, Sachin Kivasara, Viral Biravarla, and myself. All three of us are chartered accountants with 25 plus years in the equity markets.
Hey, hi Jigar. Would you mind doing a full screen of this window? Right now it's showing as a tab under a browser. Yeah, that would be better if you
Okay. So before Buoyant, I was the director of research for HSBC Bank, and prior to that, I was with Kotak Goldman Sachs. Viral is also a CA. I am Ahmedabad alumnus, last the CIO of Nippon Life Insurance, and Sachin is also a CA CW, last with Nippon Asset Management. Today, we are a 78-member team. We are managing assets north of $1.5 billion as of March, and uniquely, all of that is in only one equity strategy. Comes in two vehicles, PMS and AIF, but for us, they are vehicles to the same strategy. Over the past 9 years and 10 months, we have generated 20% TWRR post fees and expenses, which when you look at ACME puts us in the top quartile of PMS managers in India across time period. So 1, 2, 3, 5 and 7 years, we are a top quartile fund. Excuse me. But frankly, we don't manage the money looking to generate the highest returns. Right? Return above benchmark matter, but they have to come adjusted for risk across market cycles and with consistency, and I'll run you through how we stack up on all three of them. In terms of inputs, fundamentally our framework is different versus a few other funds you may have met. In one line, we are diametrically opposed to buy and hold as a framework. That strategy has worked well for almost 20 out of the 25 years of active investing in India, but we think the external situation has now changed. If you go back to the early 2000s, you look at an economy that was liberalized only 8 years ago or so. You're looking at companies which were smaller and little or no foreign ownership. Over the next 2 decades, India would grow, companies would grow at an unprecedented pace, and foreign investors virtually single-handedly drove it. Their ownership increased from $8 to $600 billion. They were at their peak almost 40% of the free float and 2 times the size of mutual funds. And they did it without having a significant physical presence in India. Right? When you put in $500 billion in a country with limited feet on street, you wanted to buy the best businesses, and valuations beyond a point didn't matter. So for those 2 decades, earnings grew, so much money came in, PE multiples expanded, and the share price of a good company kept going up. And we essentially, believe that you only have to find a good company, and that stays a great investment for 2 decades. Over the past 5 or 6 years, all that has changed for 2 large reasons. One, the operating spectrum for public investing has shrunk meaningfully. Companies now list at way expensive valuation. The earlier Bajaj Finance, which is the largest compounder in 2 decades, listed at about $60 million, and we could participate when it grew 1,000x post listing. Today, a lot of companies list at $10 or $20 billion. So the initial round of growth that we had is now shared between private and public investments. And 2, FIs are no longer the single driver, retail is, but 81% of demat accounts in India have opened up post-COVID, have come in that post-COVID era. Most of the investors until recently had seen only one cycle. When things were good, they were overjoyed. When things turn south, they get despondent fairly quickly. So in our view, what was buy and hold as a framework has given way to a lot of these cycles. We see these cycles playing out across stocks, sectors and market caps. And the way we invest is to have a cyclically aware framework structure. So there are times when we are aggressive, and then we are looking to generate very strong returns when satellite is a larger part of our ownership compared to core. However, once the market we think has become fairly even and it's now moving way ahead of fundamentals, that's when we turn to preservation of capital. That's when we become defensive. Core becomes a larger part of what we do. Satellite becomes a smaller part of what we do. We have made these changes 3 times in the past 9.5 years. And there are two or three ways in which you can look at numbers, starting with what we reported to SEBI. So this is as of 31st of March 2026. Now, as you can see, we are comparing obviously Buoyant with BSE 500. Now, over the past 1 year, 2 year, 3 year, 5 year, 7 year, and since inception, we have generated returns which are above benchmark, right? But more importantly, it has come at the beta of the portfolio, which is 1 time or less. So statistically speaking, we have taken much lesser risk compared to the market to generate the returns that we have. And this has come through across cycles. So when you look at the worst possible point, so you're looking at starting from 26 September, which was the recent peak, until the end of March. Now, at its worst possible time, the small cap index was down 25%, BSE 500 was down 18.7%, and Buoyant NAV was down 13.7%. So we fell much lesser than the market in the onslaught. And since then, a rally transpired, which then fizzled out. At the end of March, the small cap index was still 24% lower. BSE 500 was 17% lower, but Buoyant NAV was only down 0.9%. So we fell much lesser than the market in the onslaught, and then sort of didn't. When you look at it across cycles, you see the performance. And this is the analysis of one such cycle. If you look at all the cycles since inception, we report a 5-year rolling up capture of 127 and a 5-year rolling down capture of 73, which tells you that every time the market has risen 100, on average we have risen 125, and when every time it's fallen 100, on average we have fallen 73. This also flows through into the rolling returns. So when you look at the 5-year rolling returns, and we roll these returns daily, which is why you see more than 1700 observations. Now, on average, our fund returns are 680 basis points ahead of the market. The minimum returns we have generated versus the market are almost similar. And we have outperformed on 96% of all days when you have completed a 5-year period. That tells you that every time an investor has spent more than 5 years with us, he has an empirical probability of a 96% empirical probability of a 550 basis points outperformance without taking a significant downside risk. Now, doing what we do, two other things are important. One is communication, which involves us being transparent, at which end we don't charge entry load, exit load, setup fee, or lock-in. Investors are free to call their capital back whenever they want. Where we do go above and beyond is communicating what we are doing with the fund. To that end, very often I write articles, they're carried in the Economic Times, and we written 141 articles where we presented views on different topics. Views on the market we put out every month in a fact sheet. Every quarter we do a detailed webinar. We did one just about 2 days back. And all the media interactions are also put up on our website. Lastly, if you look at Buoyant in its entirety since inception, as I said, 20% CAGR puts us in the top quartile of funds in India. But the beauty of this strategy is when you layer it with risk and consistency. More importantly, we follow a strategy which is entirely different vis-a-vis others and execute it through a single framework. And all of our listed equity exposure, the three of us, our spouses, and Buoyant Treasury, whatever listed equity exposure we take, we only take it through Buoyant funds. So we put all of our money where our mouth is. We now manage money for a little over 9,000 families in India, and historically we have had a very long-term relationship with most of them. So this in brief is who we are at Buoyant. In terms of understanding where we go from the current discussion standpoint, we need to be aware of two broad things. One, what are the India's dependencies and the cost of the conflict? And two, sort of how has our positioning changed? And maybe the third one, the way in which we see things forward. If we start with the dependencies first, then you see that a large part of oil and gas, and obviously this is not new now. You would have heard some version of this play out in the media across the board. India depends on the Strait of Hormuz for almost 40% of its crude imports and almost 65% of LNG imports. But India is not alone. A lot of other Asian countries are in the same sort of boat, if you must. Whereas we say oil and gas in one line, oil is pretty much a price problem, gas is an availability problem. Gas is an availability problem because India imports its gas almost 100% in the liquefied format, whereas gas actually can travel, and it does travel predominantly through pipelines in most of the other parts of the world. So when India needs to import more, you are likely to, bid it out in the cargo. That becomes very difficult. Gas also becomes important from the timeline standpoint. So our Kharif sowing essentially begins in the end of May. And by the start of May, you would at least want the fertilizers to be in the domestic rural godowns. In order to do that, given that you are in this lockout zone, you will likely have to do emergency procurement because 80% of the LNG that the fertilizer plants use is imported. Right? You cannot let a crop cycle fail. India has never let crop cycle fail. So what government will try to do is make the gas availability issue an equivalent to a pricing issue, right? And therefore take higher cost, but make gas available to everybody, which essentially brings us to the cost of this conflict for India. Now, if you work with our assumptions, we must look at the impact from two standpoints, from a fiscal and a BOP basis. So fiscal is P&L. The balance of payment is essentially your cash flow. So if the crude prices stay higher by $30 for about 3 months, the impact of this will be on three large agencies. There will be an impact on the fiscal deficit, which we assess at around 0.25% of GDP, assuming that there are no buffers available. There will also be impact on corporate profits, and some of it will be passed on. This is our current assessment of how things will be. So your fiscal deficit will be a little bit higher, your corporate profits will be a little bit lower, we assess at around 3%, and your inflation will move up. Besides this impact, on the cash flow standpoint, you also have to account for the fact that the remittances that come from the Gulf may reduce. We are working with a 20% drop number. The net FDI will essentially offset this because in the net FDI number, you see a large amount of repatriations of the companies that were getting listed in India, and the PE and VC firms taking that money were included. Assuming some part of it gets retained back and FIIs sell out a little bit, the net impact on the balance of payment is around $24 billion, which is only 5% or less than 5% of the deployable foreign currency reserve assets that India has. So if the situation winds down in about 3 months, then you have, your fiscal deficit increasing by about 25 basis points in absence of any buffers, your corporate profits falling 3%, and about 5% draw on the forex reserves, which is not really a very meaningful number. However, against this, the corrections that the market saw was quite dramatic. So from the 52-week high, the micro caps, which is company 501 all the way down, they fell almost 40%. Small caps fell 27% on average, and so on for the large cap stocks. Now, our positioning here was very different. Right? Getting into the conflict, we were of the opinion that the Indian economy was changing gears. Post-COVID, the central, state and PSU capex was growing at such a strong number that it was pulling India's GDP higher. Post 2024, however, we started seeing that the states have started spending a lot more on social infrastructure and are not having enough money to do the capex. And the union government can also do capex only in a few areas, and they were also stagnating over the past couple of years. And a large amount of sum was given in the hands of people. We total that number to about 1.7% of GDP. So while the change in gears is happening, our historical experience is that it takes time for that to show up in the corporate profitability. And you saw how the corporate profits essentially started slowing down materially. And had it not been for the very strong flows, now you are familiar with this chart, this is essentially DII versus FII flows. And given how strong the flows have been, you saw the markets not collapse completely, given that the earnings didn't come through and the US deal didn't happen. Now, in light of all of this, there are two ways to think. One, retail doesn't have a lot of experience and they are giving exit to every known smart investor in the world. And the other way to think is that only 7% of household savings is coming into equities. That number can easily be 10%, given that across the world that number is upwards of 20%. In which case, we are looking at more than doubling of domestic inflows going forward. However, our approach to this was to systematically reduce our exposure to small caps. If you focus on more recent changes, post-budget, we were having almost 61% in small and mid caps, which fell to almost 42% by November 2025. Part of the reason why Buoyant was able to report reasonably strong, numbers even when you look at it from September 2024 is because we are continuously reducing the exposure to small and mid caps. It's reducing the exposure to satellites. In terms of way forward, we, in the light of the the conflict that happened, we reassessed our portfolio on three large parameters. What's the earning risk looking like? And even here we looked at across the board, not just crude and margin compression, but supply chain and demand destruction as well. What is the risk on the valuation? So, absolutely high sort of stocks versus FPI flow risk, and also looked at the tail risk. So what if the, geopolitical tail continues to be very high? And we have come to a conclusion that the portfolio risk score is about 2 on 5. The stocks that are truly in red zone are only 3.6, whereas ones in the gray zone, in the red zone, are fairly higher. In light of this, we have changed our stance to aggressive at the end of March 2026. In the past, when we have been defensive, the idea has been, as I showed in theory, to protect the capital. We are not looking to outperform dramatically. But once when we get aggressive, we think that the large part of the risks have been priced in, and we are looking to dial the portfolio beta up, as you see in our aggressive stances compared to down when we are looking at defensive. And our execution then rests on three parts. One is upgrade the portfolio beta within core. Second is to dial the satellite exposure meaningfully, and then add small and mid caps if the market offers some correction. Now, obviously, we are not aware on how this story plays out. So we are not aware as to. So we are not entirely sure on whether the West Asia crisis continues to worsen before it improves, or earnings take time to come through. But as at the end of March, things appeared fairly in line for you to then start looking at dialing some beta higher. So this is sort of who we are, what we do, and our views on the market. If there are questions, I'll be happy to answer. IT, see what the agentic AI is doing is essentially reducing the amount of time that project deliveries take. In our opinion, that doesn't pose a very large risk to the existing jobs in IT, but you will have to start thinking about how do you think on terminal growth. Going into the deployment over the past 2 years or so, we have had very limited exposure to IT stocks, and in the fall, we haven't really dialed that up either. Whereas the risk of job losses is not high. The terminal value will continue to be questioned, in which case, we are better off not with IT than with it. Yes. See, the fair value of the rupee, in our opinion, is around 90s or thereabouts. The fundamental value of a currency is dependent on the difference of the interest rates. So if you look at the policy rate differential between India and US, that number was at 8% in 2013 when India was in the Fragile Five. That number fell to 4% during COVID, and today it is only 1.5%. So you would expect rupee to depreciate only at around 1.5% per annum. But over the past sort of 7 months or so, where you've seen a sharp depreciation, fair value is around 90. So once it sort of depreciates, it doesn't appreciate in a hurry, but we would likely see a flattish line for a reasonably long period. So see, like debt at what level, household saving levels, or what exactly, if you can elaborate on the question. I can take this to mean that the broad number that you see in the US as a consumer plus all other debts included, that is not the right number to look at. The right number to look at is because see when somebody is borrowing, somebody is lending or saving, right? You're not creating credit out of thin air. In which scenario, at across the country level, it is balanced. Now, whoever has asked that question, if they can specify if there's a particular country about what they are worried about, then I'll happily answer that question. So see, in India, basically you see very limited requirement for staying out of market. Right? Over the past 25 years, there have been close to 6,500 trading days, and only the best 10 days have accounted for more than 50% of the returns. So in a lopsided market like that, getting out of the market and staying in cash doesn't really make sense. India's earnings have kept growing at around 12 or 13% CAGR for a very long period of time, and we think that number will likely continue. So, the way in which we run it is to dial risk up and down, but every other sort of fund manager would have a different line of thought, different view of managing risk. And I would say, staying invested is the best course of action, actually. So see, 52-week high is not a great number because imagine if you are falling for 3 years, then, over 1 year period, it would look like that you have gone up again. So I would urge the, person who asked the question to look more from an all-time high and low perspective. Secondly, see, small caps as a cohort, like if I look at the index, they've fallen and are now in line with the projected earnings growth. But large caps are the ones which have become cheaper relative to both their history as well as relative to the implied earnings growth. And to that extent, our preference still is larger cap companies. Gold and silver, at least the silver part, we used to have some equity represent that part. But see, like gold is traditionally seen as a anti-dollar trade, right? If dollar debasement happens, this is the best way to play it. However, anybody or any currency that tries to become a part of your global reserve setup needs to display a lot lesser volatility than gold and silver traditionally have. So my sense would be that you will see a prolonged period of a flattish return, and before which gold and silver becomes attractive again. So the one position that we had in the commodities complex, we have taken some money out there. Way forward for equity is that over longer periods, it essentially grows in line with earnings. Historically, we have grown 12 or 13%, and my sense is that the air pocket that got created because of the transition in the economy should see some level of sort of settling down. So my belief is that once the war-related expenses are taken and the disruptions is accounted for, you will go back to that 12-13% earnings growth. When historically, over longer periods, your EPS and share price growths have almost always aligned. So that's what I would expect would happen over the next 3 to 5 year period as well. Consumption growth. The money being transferred in the hands of people needs to be taken into account. And that takes time to show up in the corporate profit growth, and we are seeing first signs of that happening. So clearly, that is one place we are fairly excited about. Lending, so people who will receive the money will consume or save. Lending institutions and consumption, both at discretionary and staple level, makes a lot of sense. Besides that, pharmaceuticals is the theme that we like. Fertilizer and chemicals is again too broad a sector. So I would say there are few interesting ideas. We do own a couple in the space. Fertilizer stocks, see, once the gas availability improves, it will be a rebound trade. But fundamentally, we don't like the business beyond the point. So it's a cost plus model. They got sold down, and they would sort of, once the gas availability increase, things would improve a little bit. But other than that, I think that's an avoidable line of business per se. Right. So FIIs, we are not very hopeful will come back in a hurry. Right? China offers them a much lower PE entry into the consumption market. Taiwan and Korea both have some or the other play on the AI trade. Japan also has some. So to that an extent, I would say, and FIs frankly haven't sold all that much. Right? If you look at the overall ownership, they are still at around $800 odd billion, of which over the past 2.5 years they have sold about $35 billion worth. Right, so clearly about 3 or 4% is what they have sold. We still have a very large overweight position in India, and I don't think they'll be in a hurry to add. Do you mind elaborating, Lokik, like what is an asset heavy? Like as in companies that have very low asset turns, is that what?
Yeah, so let's say I'll take a name of a company, let's say Zomato. I'm assuming it's a asset light company versus someone who is in the manufacturing. Are you
Essentially, so yes, Lokik, I get the distinction. See, beyond the point, we don't really sort of think of from those broad line distinctions, right? We look at essentially the way in which you are getting a business and the price you are paying to buy it. If there are very large interest rate movements, which we don't think will likely happen over the next 2 or 3 years, then this distinction becomes moot from just a direction standpoint. So no sort of very concrete views on asset light or asset heavy. Thank you, everyone. Bye-bye.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.